Hello friends, my name is Anand and you are watching the Commerce Tutor. In this video, we are going to discuss the concept of mutual fund, whom many of you want to invest into but you do not have the basic idea of what a mutual fund is, how does it work, and should you put your money into the mutual fund or not. So let us discuss the mutual fund. I have written a one-liner definition of mutual fund over here. Let us first read this definition. An investment program funded by shareholders that trades in diversified holdings and is professionally managed. So the mutual fund, as we can say, is an investment program and it is funded by the shareholders. Trades in diversified holdings and is professionally managed. We will break this definition into various parts which I have underlined and understand the importance of each and every word used over here. But before that, let us see why do we need a mutual fund, and let us understand a basic backdrop about why we needed it and how this concept came into existence. So, as we know, people in the society have some idle cash with them always, which they want to invest into some profitable venture. But these are common people, they are not professionals, and they do not have the idea where to invest such cash so that they can get a good amount of return with least risk. So people can invest at many places where there is a high return, but also high return comes with a great amount of risk. So the basic notion is where the return is high, the risk is also high. But a finance professional or a very qualified person like a chartered accountant or a stockbroker can optimize these two variables and come at a balance, or we can say the optimal point where the return is maximized and the risk is minimized at the same time. So at optimal point, what happens, the return is good but the risk is also minimum at the same point of time. So this is the ideal situation everyone wants to reach, but people with lack of professional knowledge are unable to achieve this point. So what do these people do? They keep their idle cash lying at their bank accounts, which fetch them very less interest, or ideally the funds keep lying idle without fetching any good return. So at that point of time, a mutual fund comes into play. Now what it does, a mutual fund is actually set up by a company which creates this fund. What happens, this company creates a fund, and let us consider this fund as an empty container. Okay, now these people who have idle cash, they are called for and asked to invest their idle cash into this fund. So these people, the common people of our society who have idle cash lying with them, whom these people want to invest, so they are called upon to invest this cash into this fund. So the cash is channelized from these people to this fund. So there are a lot of people in our society and everybody puts their cash into this fund. So finally, this fund becomes a pool of cash. This cash is accumulated from these people who are in the society. Now what happens, this company, what it does, it takes this pool of cash and invests this amount into a diversified portfolio. What do we mean by a diversified portfolio? By diversified portfolio, we mean that this fund is not invested in a single security, but it is invested in a diversified portfolio of many securities. This fund is invested in many securities. Some may be in the stocks of, say, real estate. Some may be in the IT sector, stocks of IT sector, pharma, etc. There may be many categories of stocks in which this fund is being invested. And who does this work? Who does the investment? So this is the investment. This pool of cash or this fund which has been created by this company and money has been pulled in from public, this pool of cash is being managed by professionally qualified people who are expert in the stock market, and they have true knowledge of where to invest this money to get the maximum return and least risk. These people are called fund managers. They are appointed by this company to take care of this fund and invest it into a diversified portfolio which gives you a good amount of return with least risk. So these fund managers are very qualified financial people who have adequate knowledge of the stock market, where they should invest how they should diversify their portfolio, where they should invest this fund. And with this expertise knowledge, this pool of cash which is invested into this portfolio manages to get a lucrative or handsome return. So what we get in return? We get a handsome return. And at the same time, we get a low risk profile. The fund is so beautifully diversified that the ups and downs of a particular stock in this portfolio will not affect the total fund, as it will be counterset or offset by the opposite ups and downs in some other stock. So that is called the beauty of a very well diversified portfolio. As a popular saying in English goes, that we should not put all our eggs in a single basket. The same concept is applied over here. But for a person, for an individual, it is not possible to be it is not possible for him to be that much expert to construct a professionally managed portfolio like this with his funds. And moreover, for a common person, he does not have that much adequate amount of cash so that he can construct a well diversified portfolio. All he can do is invest a small amount of cash in a particular stock or security, which comes with high return at some times, but also with a very high risk. So pooling all the little amounts of cash from different people in the society and creating a fund out of it and investing it into a diversified portfolio is all what a mutual fund does. And what does it take in return? It takes in return a part of the reward which it is earning for its investors. So this return which is coming from this invested portfolio is coming to the mutual fund company, and this company is then again distributing the return among the investors after deducting a small commission, and this commission is used to pay the salaries of these fund managers. So hope I could make clear how a mutual fund company works. To sum it up, small amounts of cash or investment is pooled from different people of the society. They are asked to invest in this mutual fund which is set up by this company, and then this pool of cash is available for investment. The company invests some fund managers who are professionally qualified people who can invest this pool of cash into a beautifully maintained diversified portfolio. This is the diversified portfolio, so that the return can be maximized, at the same time keeping the risk low. So return is high and risk is low with their professional expertise, and then the returns from this diversified portfolio or this investment is flown back to the investors, who are the people. So these people or investors are called the shareholders of the fund. These people are the shareholders of the fund. And this company is mutual fund company. This fund is called the mutual fund. This is the mutual fund, and it is called mutual fund because many people have mutually agreed to invest into it. That is why the name mutual fund. And this is the diversified portfolio in which the mutual fund money is invested. So this is all about the mutual fund, how it works. And as far as its advantages are concerned, let me tell you that for a single person who lives in a society, it is not possible for him to take his small amount of cash lying with him and create a beautiful diversified portfolio like this, because he does not have that much financial expertise also. And also he does not have a huge amount of cash, because when you pool small amounts of cash and make a big fund out of it, then you get a cash leverage and your bargaining power is high. At that time you can approach to companies and you can also convince them in selling their stock to you at a lower price or at a discount at some times. So let us come back to the definition itself again. So let us read it again. An investment program funded by shareholders. So mutual fund is an investment program where people invest their money into a common fund, and it is funded by shareholders. These shareholders are the people who are investing their money into the fund. or you can call it as investors, and that trades in diversified holdings. So this fund where the shareholders or the investors are putting their money, it is trading in diversified holdings. Diversified means it is a diversified portfolio where there are several securities of different nature which are being traded inside the portfolio, and it is professionally managed. Because, as in, it is managed by the fund managers who are professionally qualified people. So hope that this video gave you an insight about mutual fund. Hope you liked this video. If you like this video, please give it a thumbs up. If you like my channel, please subscribe to this channel, and please share this video with your friends, relatives, or someone else who wants to invest in a mutual fund but does not have the basic idea of what it is. Thank you for watching my video. Have a good day.